Welcome to Strategic Signal. Before we dive into the exciting world of investing, let me ask you this. Have you ever wondered what the stock market really is? How does it impact your personal wealth and the broader economy? Well, you're in the right place, because this chapter will answer all of that and more. The stock market is not just a place where stocks are bought and sold. It's a powerful engine that drives economic growth and helps build wealth for millions of people. In this video, we'll explore, first, what exactly is the stock market? We'll break down how it works, why it exists, and how it plays a crucial role in raising capital for companies while helping investors like you grow your wealth. Second, why understanding the stock market is essential for your financial future. Whether you're planning for retirement or looking to build generational wealth, knowing how the stock market operates can make all the difference. Third, a brief history of the U.S. stock market. From its humble beginnings with the Buttonwood Agreement to becoming one of the largest financial markets in the world, we'll take a quick look at how it all started. Fourth, how stock market performance reflects economic health. Did you know that stock prices often signal what's happening in the economy? We'll explain how you can use this information to make smarter investment decisions. By understanding these foundational concepts, you'll be better equipped to navigate the complexities of investing, whether you're a beginner or an experienced trader. So, if you're ready to take control of your financial future, make sure to hit that subscribe button and tap the notification bell so you don't miss any of our upcoming videos. Trust me, you won't want to miss what's coming next. Chapter 1. Introduction to the U.S. Stock Market. Overview of the stock market. The stock market is a dynamic and complex network where shares of publicly traded companies are bought and sold. It functions as a marketplace that facilitates the exchange of ownership claims on these companies, enabling investors to trade shares in real time. The primary purpose of the stock market is to allow companies to raise capital by selling shares to investors, while providing a platform for investors to buy and sell these shares among themselves. Key components of the stock market include: first, exchanges, the primary venues where stocks are traded, such as the New York Stock Exchange, NYSE, and Nasdaq. Second, investors, individuals or institutions that buy and sell stocks, ranging from casual retail investors to large institutional investors. Third, securities, financial instruments like stocks, bonds, and derivatives that represent ownership or debt. The importance of understanding the stock market. A solid understanding of the stock market is crucial for several reasons. First, wealth building. Historically, investing in stocks has provided higher returns compared to other asset classes, like bonds or real estate. Over time, equities have outperformed other investments, making them vital for wealth accumulation strategies. Second, financial literacy. Knowledge of how the stock market operates enhances financial literacy. Investors who understand market mechanics can make informed decisions about their investments, manage risks effectively, and develop strategies tailored to their financial goals. Third, retirement planning. Many retirement plans, such as 401(k)s and IRAs, heavily invest in stocks. Understanding how these investments work can help individuals better prepare for their financial future. Fourth, economic indicators. The stock market serves as a barometer for economic health. Changes in stock prices often reflect broader economic trends, helping investors gauge the overall economic climate. Types of stocks. There are two primary types of stocks. 1. Common stock represents ownership in a company, entitling shareholders to vote on corporate matters and potentially receive dividends. Common stockholders experience capital gains or losses, depending on the company's market performance. In case of liquidation, common shareholders are last in line to receive compensation after debts, and preferred shareholders are paid. 2. Preferred stock does not typically grant voting rights, but preferred shareholders receive a fixed dividend. They have a higher claim on assets than common shareholders, meaning they get paid first in the event of bankruptcy. Clarifying the role of the stock market for different types of investors. The stock market serves various roles depending on the type of investor involved. First, long-term investors focus on fundamental analysis, investing in companies with strong growth potential, and holding their investments for years or decades to benefit from compounding returns. Second, day traders seek to profit from short-term price movements by buying and selling stocks within a single trading day, relying on technical analysis and executing multiple trades. Third, institutional investors, entities like pension funds, mutual funds, and hedge funds that manage large pools of capital, often influence stock prices due to their substantial buying or selling power. Fourth, retail investors, individual investors who buy and sell securities for their personal accounts rather than for an organization. They may adopt various strategies based on their risk tolerance and investment goals. Some may invest for growth, while others may focus on income through dividends. Investment strategies. To enhance your understanding of investing in the stock market, it is crucial to explore various investment strategies. First, value investing. This strategy involves seeking undervalued stocks that the market may have overlooked, with the expectation that their price will eventually rise to reflect their true worth. Second, growth investing. This approach focuses on companies with high growth potential, even if their current valuations seem high. Investors anticipate that future earnings growth will justify these prices. Third, dividend investing. This strategy targets companies that consistently pay dividends, providing a steady stream of passive income. Risk management. Investing in stocks carries inherent risks. Therefore, it's essential to discuss risk management techniques. Diversification. Spreading investments across various sectors or asset classes can reduce exposure to any single asset's volatility. Position sizing. Determining how much capital to allocate to each investment based on your overall portfolio strategy helps manage risk effectively. For example, if you have a $10,000 portfolio and decide that no single investment should exceed 10%, you would limit each position to $1,000. Stop loss orders. Setting predetermined exit points on trades can help limit potential losses by automatically selling a security when it falls below a certain price. For instance, if you purchase a stock at $50 and set a stop loss order at $45, your losses will be capped at $5 per share. Dollar cost averaging. This technique involves consistently investing a fixed amount over time, regardless of price fluctuations. For example, if you invest $100 every month into an index fund, you buy more shares when prices are low, and fewer when prices are high, averaging your cost over time. Relationship between risk and return. Understanding the relationship between risk and return is fundamental to investing. Generally, higher potential returns come with increased risk. For example, stocks tend to offer higher returns than bonds, but also come with greater volatility. Emerging markets may provide substantial growth opportunities, but carry risks related to political instability or currency fluctuations. This principle underscores why assessing your risk tolerance is crucial before making investment decisions. Consideration of market psychology. Market psychology plays an essential role in investor behavior. First, concepts like fear and greed can significantly influence buying and selling decisions. Second, herd behavior often leads investors to follow trends rather than make independent analyses, sometimes resulting in bubbles. For example, dot-com bubble, or crashes, for example, 2008 financial crisis. Understanding these psychological factors can help investors remain more rational during volatile periods. Introduction to different market indicators. While detailed analysis will follow in later chapters, it's beneficial to familiarize yourself with common market indicators. Dow Jones Industrial Average. Dow Jones Industrial Average, a price-weighted index representing 30 significant publicly traded companies in the U.S., often used as an indicator of overall market performance. The Dow Jones Industrial Average is a price-weighted index, meaning that the index level is based on the stock prices of 30 large U.S. companies. The formula for calculating the Dow Jones Industrial Average is Dow Jones Industrial Average equals sum stock prices of 30 companies divided by Dow Divisor. For example, if the sum of the stock prices of all 30 companies is $4,500, and the Dow Divisor is 0.1517275259538, then Dow Jones Industrial Average equals 4,500 divided by 0.1517275259538 equals 29,622.77. Dow Divisor calculation. The actual Dow Divisor itself isn't calculated directly by a formula. Instead, it's determined and periodically updated by S&P Dow Jones indices to account for corporate actions like stock splits, spin-offs, or component changes in the index. These adjustments keep the index consistent over time. Understanding the Dow Divisor. First, purpose of the divisor. It maintains the index's continuity. When an event would otherwise impact the index's level, the divisor changes accordingly. Second, adjustment for corporate events. When a stock in the Dow Jones Industrial Average undergoes a split, or pays a significant dividend, the divisor is adjusted to ensure that the index level doesn't change merely because of these events. Third, current divisor value. As of recent years, the Dow Divisor has been a value less than, making it effectively a multiplier that inflates the sum of stock prices in the Dow Jones Industrial Average. Effective stock splits and reverse stock splits on the Dow Jones Industrial Average. The Dow Jones Industrial Average, Dow Jones Industrial Average, is a price-weighted index, meaning that the price of each stock in the index directly impacts the overall value of the Dow Jones Industrial Average. Stocks with higher prices have a greater influence on the index. Therefore, when a company in the Dow Jones Industrial Average undergoes a stock split or reverse stock split, It affects the index's calculation, but adjustments are made to ensure that the index remains stable and accurately reflects market performance. 1. Effect of a stock split on the Dow Jones Industrial Average. A stock split increases the number of shares outstanding, while reducing the price per share proportionally. This is often done to make shares more affordable to investors, without changing the company's overall market value. 1. Impact on Dow Jones Industrial Average. Since the Dow Jones Industrial Average is price-weighted, a stock split reduces the share price of a company in the index. Without adjustment, this would lower the company's influence on the index and cause an artificial drop in the Dow Jones Industrial Average. The adjustment via Dow divisor. To prevent this artificial drop, the Dow divisor is adjusted downward by dividing it by the split factor, for example, 2-for-1 split. This ensures that the stock split does not affect the overall value of the Dow Jones Industrial Average. Nvidia, Nasdaq, NVDA, underwent a 10-for-1 stock split in 2024. Before the split, Nvidia's high stock price could have given it too much weight in the Dow Jones Industrial Average. After splitting its shares, Nvidia's share price dropped from over $1,000 to around $120, making it more accessible to investors, while maintaining its market capitalization. The Dow divisor was adjusted to ensure that Nvidia's lower share price did not negatively impact the Dow Jones Industrial Average. 2. Effect of a reverse stock split on the Dow Jones Industrial Average. 2. Effect of a reverse stock split on the Dow Jones Industrial Average. A reverse stock split reduces the number of shares outstanding, while increasing the price per share proportionally. Companies often do this to meet minimum price requirements for exchange listings, or improve their stock's perception. 1. Impact on Dow Jones Industrial Average. A reverse stock split increases a company's share price, which would give it more weight in a price-weighted index like the Dow Jones Industrial Average. 1. Without adjustment, this could artificially inflate the index. 2. Adjustment via Dow divisor. To prevent an artificial increase in the Dow Jones Industrial Average, the Dow divisor is adjusted upward to offset any changes caused by the reverse split. General Electric, NYSE, GE, executed a 1-for-8 reverse stock split in 2021. This reduced its outstanding shares, while increasing its stock price from around $12 to $96 per share. The Dow divisor was adjusted accordingly to ensure that GE's higher post-split share price did not disproportionately affect the Dow Jones Industrial Average. When is this effect reflected on the Dow Jones Industrial Average? The effect of stock splits or reverse splits on the Dow Jones Industrial Average is reflected immediately after trading begins on the first day following the corporate action. For example, 1. Nvidia's 10-for-1 stock split was reflected in the Dow Jones Industrial Average before trading started on June 10, 2024. 2. General Electric's reverse stock split took effect after trading closed on July 30, 2021, and was reflected when trading resumed on August 2, 2021. In both cases, adjustments to the Dow divisor ensured that these corporate actions did not distort or misrepresent market performance within the index. Nasdaq Composite Index, an index primarily tracking technology stocks, It reflects trends within tech-heavy sectors and serves as an indicator for growth-oriented investments. The Nasdaq Composite is also a market capitalization weighted index, primarily tracking technology stocks. Its value is calculated by summing up the market capitalizations, stock price shares outstanding, of all listed companies, and dividing by a divisor. Nasdaq Composite Index level equals sum, stock price times shares outstanding, divided by divisor. Example calculation. If the combined market capitalization of all Nasdaq listed companies is $15 trillion and the divisor is $1 billion, Nasdaq Composite Index level equals 15 trillion, divided by 1 billion equals 15,000. However, there is no simple formula to calculate the divisor directly, as it is a constant set by the index provider, Nasdaq, and adjusted over time to account for corporate actions, like stock splits, reverse stock splits, dividends, and mergers. Reverse stock splits, dividends, and mergers. Below, we will apply the concepts of stock splits, reverse stock splits, and their effects on the Nasdaq. The effect of stock splits on the Nasdaq Composite Index. A stock split increases the number of shares outstanding, while proportionally reducing the price per share. Since the Nasdaq Composite is weighted by market capitalization, not price, stock splits do not directly affect the index's value, as they would in a price-weighted index like the Dow Jones Industrial Average. In a market cap-weighted index, like the Nasdaq Composite, a stock split does not change a company's overall market capitalization. Market cap equals share price times shares outstanding. Therefore, a stock split has no direct effect on the index's value, as both the share price and shares outstanding adjust proportionally. Let's say Apple, AAPL, which is part of the Nasdaq Composite, undergoes a 4-for-1 stock split. If its pre-split price is $400, and its market cap is $2 trillion, after the split, its price will drop to $100 per share, but its number of shares will quadruple. The market cap remains $2 trillion, so Apple's weight in the Nasdaq Composite remains unchanged. Apple, AAPL, underwent a 4-for-1 stock split on August 31, 2020. Before the split, Apple's share price was around $500. After the split, it dropped to around $125 per share. However, because Apple's market capitalization did not change, its influence on the Nasdaq Composite remained constant. The effect of reverse stock splits on the Nasdaq Composite Index. A reverse stock split reduces the number of shares outstanding, while increasing the price per share proportionally. Similar to regular stock splits, reverse splits do not affect a company's market capitalization, and thus have no direct impact on the Nasdaq Composite Index. In a reverse stock split, while the share price increases, the number of shares decreases in proportion. Since market capitalization remains unchanged, market cap equals share price times shares outstanding, there is no direct effect on the index's value. If a tech company like SiriusXM Holdings, SIRI, undergoes a 1-for-10 reverse stock split, and its pre-split price is $5 per share with 10 billion shares outstanding, market cap equals $50 billion. After the reverse split, its price will rise to $50 per share, with only 1 billion shares outstanding. The market cap remains at $50 billion, so its weight in the Nasdaq Composite does not change. SiriusXM Holdings, SIRI, executed a 1-for-10 reverse stock split in December 2020. Its share price increased from around $6 to approximately $60 post-split. However, since its market capitalization remained constant, this action did not significantly impact its weight in the Nasdaq Composite Index. When are these effects reflected in the Nasdaq Composite? The effects of stock splits and reverse splits are reflected in the Nasdaq Composite Index as soon as trading begins on or after the X date, the first day that trading occurs post-split. For example, Apple's 4-for-1 stock split was reflected in the Nasdaq Composite when trading resumed on August 31, 2020. SiriusXM Holdings reverse stock split was reflected in December 2020 when trading began after the corporate action took effect. S&P 500, a broader index comprising 500 large-cap U.S. companies. It provides insight into overall market health and performance across various sectors. The S&P 500 is a market capitalization weighted index, meaning that companies with larger market capitalizations have a greater influence on the index. Below, we will apply the concepts of stock splits, reverse stock splits, and their effects on the S&P 500 index. Formula for calculating the S&P 500 index. S&P 500 index level equals sum stock price times shares outstanding divided by divisor. 1. Stock price times shares outstanding gives the market capitalization of each company. 2. The divisor is a proprietary value provided by S&P Dow Jones Indices, adjusted over time to account for corporate actions like stock splits, dividends, and mergers. The divisor ensures that corporate actions do not artificially distort the index's value. Example calculation using real data, 2024. Let's calculate a simplified version of the S&P 500, using 3 companies as an example. Assume we have the following companies in the S&P 500. Step 1. Calculate market capitalization for each company. Using only 3 companies, Company 1 market cap equals 350 times 7.5 billion equals 2625 billion. Company 2 market cap equals 180 times 16.5 billion equals 2970 billion. Company 3 market cap equals 450 times 2.5 billion equals 1125 billion. Step 2. Sum of market capitalizations. Sum, market cap, equals 2625 plus 2970 plus 1125 equals 6720 billion. Sum, market cap equals 2625 plus 2970 plus 1125 equals 6720 billion. Step 3. Apply the divisor. The current divisor for the S&P 500 is approximately 8.9 billion. As of recent data. This divisor is adjusted over time to account for corporate actions like stock splits and dividends. S&P 500 index level equals sum market cap divided by divisor. S&P 500 index level equals divisor sum market cap equals 6,720 billion. Divided by 8.9 equals 755.06. This simplified example shows how the S&P 500 index level would be calculated using only 3 companies. Effect of stock splits on the S&P 500. A stock split increases the number of shares outstanding, while reducing the price per share proportionally. Since the S&P 500 is weighted by market capitalization, not price, stock splits do not directly affect the index's value. In a market cap weighted index like the S&P 500, a stock split does not change a company's overall market capitalization. Market cap equals share price times shares outstanding. Therefore, a stock split has no direct effect on the index's value, as both the share price and shares outstanding adjust proportionally. If Apple, AAPL, part of the S&P 500, undergoes a 4-for-1 stock split, its pre-split price might be $400 with a market cap of $2 trillion. After the split, its price drops to $100 per share, but its number of shares increases fourfold. The market cap remains $2 trillion, so Apple's weight in the S&P 500 remains unchanged. Nvidia, NVDA, underwent a 4-for-1 stock split in July 2021. Before the split, Nvidia's share price was around $800. After the split, it dropped to around $200 per share. However, because Nvidia's market capitalization remained constant, its influence on the S&P 500 did not change. The divisor was adjusted to reflect this action. 3. Effective reverse stock splits on the S&P 500. A reverse stock split reduces the number of shares outstanding, while increasing the price per share proportionally. Similar to regular stock splits, reverse splits do not affect a company's market capitalization, and thus have no direct impact on the S&P 500 index. In a reverse stock split, while the share price increases, the number of shares decreases in proportion. Since market capitalization remains unchanged, market cap equals share price times shares outstanding, there is no direct effect on the index's value. If a company like SiriusXM Holdings, SIRI, undergoes a 1-for-10 reverse stock split, its pre-split price might be $5 per share with 10 billion shares outstanding. Market cap equals $50 billion. After the reverse split, its price rises to $50 per share with only 1 billion shares outstanding. The market cap remains at $50 billion, so SiriusXM's weight in the S&P 500 does not change. In May 2022, Dexcom Incorporated, DXCM, executed a 4-for-1 reverse stock split as part of its effort to maintain listing requirements and improve its stock's perception among investors. This reverse split increased Dexcom's share price, but did not affect its market capitalization or its weight in the S&P 500 index. When are these effects reflected in the S&P 500? The effects of stock splits and reverse splits are reflected in the S&P 500 index as soon as trading begins on or after the X date, the first day that trading occurs post-split. For example, Broadcom's AVGO July 2024 stock split 10-to-1 was reflected in the S&P 500 when trading resumed on July 15 after it took effect. Dexcom's May reverse stock split was reflected immediately after trading resumed following its effective date. Market participants and their impact. Understanding various market participants helps clarify how they contribute to the overall functioning of the stock market. Market makers. Market makers play a crucial role in providing liquidity within financial markets. First, liquidity provision, and second, facilitating transactions, and third, stabilizing prices. First, liquidity provision. Market makers are firms or individuals that quote both buy, bid, and sell, ask, prices for specific securities held in inventory. By doing so, they ensure that there is always a buyer or seller available. for investors looking to trade. Example: Apple Incorporated, AAPL. Suppose a market maker is quoting a bid price of $180 and an ask price of $180.10 for Apple shares. This means the market maker is willing to buy Apple shares at $180 and sell them at $180.10. If an investor wants to buy 100 shares of Apple, they can purchase them from the market maker at $180.10. Conversely, if another investor wants to sell 100 shares, they can sell them to the market maker at $180. By continuously providing these two-sided quotes, the market maker ensures that there is always liquidity in the market for Apple shares, allowing investors to trade without significant delays or large price swings. Real-world example: Citadel Securities, one of the largest market-making firms in the U.S. Citadel Securities provides liquidity across numerous stocks, including high-demand stocks like Apple and Microsoft. Dividend investing. This strategy targets companies that consistently pay dividends, providing a steady stream of passive income. Citadel continuously quotes buy and sell prices during trading hours, ensuring that investors can trade these stocks efficiently with minimal price slippage. Second, facilitating transactions. They help maintain an orderly market by stepping in to buy or sell when there are imbalances between supply and demand. This function stabilizes prices and reduces volatility during periods of high trading activity. Example: Tesla Incorporated, TSLA. Suppose Tesla stock experiences a sudden surge in demand due to positive earnings news, causing more buyers than sellers in the market. If no sellers are available at current prices, the stock price could spike dramatically. However, a market maker steps in by selling Tesla shares from its own inventory at a reasonable price. For example, $250, preventing the stock from rising too quickly. Conversely, if there is a sudden sell-off, for example, due to negative news, the market maker may step in to buy Tesla shares at a fair price, $245, preventing the stock from crashing too rapidly. Real-world example: Designated Market Makers, DMMs, on NYSE. DMMs on the New York Stock Exchange are responsible for ensuring that there is sufficient liquidity during opening and closing auctions, as well as throughout the trading day. For example, during periods of heightened volatility, like earnings announcements or macroeconomic news releases, DMMs help stabilize prices by stepping in to buy or sell shares when there are imbalances between buyers and sellers. Third, stabilizing prices. Market makers and other financial participants play a critical role in stabilizing prices during periods of high volatility. This function is essential for maintaining orderly markets and ensuring investor confidence, especially when market conditions become erratic due to sudden shifts in supply and demand. How market makers stabilize prices. First, market makers stabilize prices by stepping in to provide liquidity when there is an imbalance between buyers and sellers. During periods of high volatility, such as after major news announcements or economic events, there can be a surge in either buying or selling activity. This can lead to rapid price swings, which may destabilize the market. Suppose a major technology company like Apple, AAPL, reports disappointing earnings, leading to a sudden surge of sell orders. Without sufficient buyers, Apple's stock price could plummet rapidly. A market maker steps in by purchasing shares from sellers at a reasonable price, preventing the stock from crashing too quickly. This action helps moderate the downward movement and ensures that the price doesn't fall too far below its fair value. Second, stabilizing bids are another tool used to prevent excessive price declines during volatile periods. These are bids placed by underwriters or market participants to prevent a stock from falling below a certain level, often during an initial public offering, IPO, or after an important corporate event. During an IPO, if the demand for shares is lower than expected, the stock price may start to fall rapidly. To prevent this, underwriters may place stabilizing bids at specific price levels to create a price floor, ensuring that the stock does not drop too far below its offering price. Example: in 2021, during the IPO of Rivian Automotive, RIVN, underwriters used stabilizing bids to support the stock price during its initial days of trading. This helped maintain investor confidence and prevented the stock from experiencing excessive volatility immediately after its debut. Third, reducing volatility through liquidity provision. During periods of high volatility, market makers also reduce volatility by continuously providing liquidity, quoting both buy, bid, and sell, ask, prices for securities. By doing so, they ensure that there is always a counterparty available for trades, preventing large gaps between buy and sell orders that could lead to sharp price movements. If a large institutional investor wants to sell a significant number of shares of Tesla, TSLA, during a volatile trading session, this could cause Tesla's stock price to drop sharply if there are not enough buyers at current prices. A market maker steps in by purchasing these shares at a reasonable price, absorbing the selling pressure, and preventing Tesla's stock from falling too rapidly. Fourth, stabilizing prices during market crashes or corrections. Market makers and other financial institutions may step in to stabilize prices across multiple securities. For example, during the COVID-19 pandemic in March 2020, markets experienced extreme volatility as investors reacted to uncertainty about the global economy. In March 2020, as markets around the world plunged due to fears surrounding COVID-19, market makers played a crucial role in stabilizing prices by continuing to provide liquidity despite extreme selling pressure. This helped prevent even deeper declines in major indices, like the S&P 500 and Nasdaq Composite. Fifth, impact on investor confidence. By stabilizing prices during volatile periods, market makers help maintain investor confidence in financial markets. When investors see that prices are not swinging wildly, even during times of uncertainty, they are more likely to continue participating in the market, rather than panic selling their holdings. During periods of high volatility, following major news events, such as elections or Federal Reserve announcements, market makers' actions can reassure investors that there will always be liquidity available for their trades. This reduces panic selling and helps maintain orderly markets. Brief history of the U.S. stock market. The U.S. stock market has a rich history that dates back to the late 18th century. Here are some key milestones. 1792. The foundation of the New York Stock Exchange, NYSE, began with the Buttonwood Agreement, signed by 24 stockbrokers on Wall Street. This agreement established rules for trading securities and marked the beginning of organized stock trading in America. Early 1800s, the NYSE evolved from informal trading in coffeehouses into a formal organization by 1817, when brokers adopted a constitution outlining trading regulations. 1867. The introduction of the stock ticker revolutionized how market information was disseminated, allowing rapid communication across distances. This innovation significantly improved trading efficiency. 1929. The infamous Wall Street crash marked a pivotal moment in U.S. financial history, leading to widespread economic hardship during the Great Depression. This event prompted regulatory reforms, including establishing the Securities and Exchange Commission, SEC, in 1934, to oversee securities markets. Modern era. Today, the U.S. stock market is one of the largest and most sophisticated globally, encompassing various exchanges, like Nasdaq with over 5,000 listed companies, totaling more than $50 trillion in market value. It provides diverse financial products beyond stocks, including ETFs, bonds, and derivatives. Alexander Hamilton's role in shaping the U.S. stock market. Alexander Hamilton was instrumental in shaping the U.S. stock market through his innovative policies as the first Secretary of the Treasury from 1789 to 1795. His contributions laid vital groundwork for modern American finance. Establishing public credit. Hamilton proposed that the federal government assume state debts incurred during the Revolutionary War, enhancing national legitimacy and stabilizing public credit through government bonds that created a marketplace for securities, encouraging private investment. Creation of a central bank. He advocated establishing a central bank, the first bank of the United States, in 1791. This institution facilitated government transactions and regulated credit availability, preventing financial panics. Promoting securities markets. His funding and assumption plan created a marketplace for government securities through bond issuance. The Buttonwood Agreement established rules for trading stocks among brokers on Wall Street, a foundational moment for what would become NYSE. Economic policies supporting manufacturing. Hamilton implemented protective tariffs on imported goods, promoting domestic manufacturing, while reducing reliance on foreign products, fostering an environment conducive to investment in American industries. Third and fourth markets. Understanding these markets is crucial for advanced trading concepts. Third market involves OTC trading of exchange listed securities by institutional investors seeking anonymity or better pricing than available on traditional exchanges. Fourth market, direct trading between institutions without intermediaries, allows large transactions without impacting public markets significantly, often facilitated through electronic communication networks, ECNs. Thanks for watching Strategic Signal. I hope you found this video insightful and helpful as you continue your journey in mastering the stock market. Before you go, don't forget to hit that subscribe button and tap the notification bell so you don't miss any of our upcoming videos. Trust me, you won't want to miss what's coming next as we dive deeper into the world of investing and unlock even more strategies to help you succeed in the markets. Also, we've packed the video description with questions and answers that might help clarify some of the concepts we discussed today. So, be sure to check that out. And now, I'd love to hear from you. What did you think about this chapter? If you have any questions or thoughts, feel free to drop them in the comments section below. I'll be checking and responding to as many as I can. Thanks again for tuning in, and I'll see you in the next chapter.